Welcome back to yet another episode of the Trader's Brew, where we roll up our sleeves and mix the latest market trends, insights, and global events into one potent brew without the hangover. I'm your host, Cass, and today we've got a hot topic brewing: the future of Forex. Now, I'm sure anyone following the news lately will notice how much market uncertainty is heating up, thanks to the tariff tensions for a big part and the ripple effects from monetary shifts worldwide. Now, from the US trade war to global consequences of economic policy shifts, there's no shortage of volatility in the markets. So we're finding ourselves asking, what's ahead for Forex? Is the landscape shifting? And if so, how can you, as a trader, navigate this tariff-fueled storm? Joining us today is our very own market analyst, Justin, an expert on global currency trends with years of experience trading across various markets. Justin, welcome to the Trader's Brew.
Hey, Cass, thank you for having me here today.
Oh, great. Let's start with some context for all of our listeners. Forex has always been a high-stakes game, but recent developments, especially around the US with the ongoing trade war, are shaking things up. Now, the pressure from the tariffs, the risk of recession, and shifting monetary policies are making traders rethink their strategies. So, Justin, to start, would you mind giving us a brief overview of how Forex trading has evolved and why this topic is especially relevant right now?
Sure. Well, the Forex world has seen a lot of change since I started trading it way back in 2001. In the post-COVID boom of 2022, trading volumes hit record highs, roughly 7.5 trillion a day. It used to be like 5 trillion. So this is driven by wild swings in inflation, energy prices, and geopolitics. Since then, technology and policy have reshaped the game, I would say. Now, retail traders have more powerful apps nowadays and AI-powered tools at their fingertips. So Forex isn't just an institutional playground anymore. Small investors can jump in 24/7 and they can have a go at Forex. Meanwhile, central bank moves, examples like the Federal Reserve, they made aggressive rate hikes in 2022 to 2023, and probably cuts by this year created a roller coaster for currencies. So this makes Forex especially relevant till today. Currency markets sits at the heart of global finance. Any big events, like for example, a war that's going on in Ukraine, in Gaza, trade deals, in the past, a pandemic, ends up moving Forex rates, in great ways, in many ways. So in fact, the recent mix of what we call stubborn inflation, decrease in interest rates done by the central banks, and supply chain realignments have meant that currency swings affect everything from import prices to tech stocks. So if you follow the news, you hear about like US versus China tensions one day and about recession fears the next. Currency markets react instantly to all this. So in a sense, Forex is both the canary in the coal mine, or you can also say the engine of global trade. So with so much happening internationally, like the wars, like I mentioned earlier, the US-China friction, understanding Forex is crucial to see which way the winds are blowing in finance right now.
Right. Okay. So that was a very good breakdown of everything going on with Forex, especially the canary in the coal mine part. Now, some people might perceive the dollar itself, the US dollar itself, as the canary in the global markets. Now, as we know, the US trade war has had quite a serious influence on the disruptions with the markets going on, especially with Trump's tariffs as the primary weapon in this economic battle. Now, in your opinion, how are these US-based movements affecting global Forex trading right now?
I would say a lot of recent turmoil in Forex has a made in USA label.
Mm.
First, the trade war and tariffs. Remember the headline news in 2022 to 2023? The US kept many of the Trump era tariffs on China and even slapped new ones on steel, EVs, and restriction on selling semiconductors and chip making equipment to China. That created uncertainty in the currency markets. When China's exports were hit by US tariffs, the yuan tended to weaken since foreign buyers demand less yuan to pay for Chinese goods. At the same time, these tariffs made other exporters cheaper by comparison. Some supply chains shifted to Vietnam and Mexico, for example. So currencies like the Mexican peso and the Vietnamese dong saw mixed impact. In April 2025, for example, an announced plan for broad US tariffs on imports sent ripples through the Forex market. As you know, the Hong Kong market fell, the yen plunged to record lows, and even safe currencies like the Japanese yen and the Swiss franc jumped as investors got nervy. This shows how trade policies, tax on imports doesn't just affect good prices, but also who buys which currency. Then there's also the issue of monetary policy. Since the 2022, the US Federal Reserve turned very hawkish to fight inflation, raising rates from near zero up to 5%. That made the US dollar very attractive to investors seeking yield, which in turn strengthened the US dollars globally through 2022 to 2023. So during that time, we saw global money flowing into US bonds, while other countries faced capital outflows and had to hike their own rates to keep up. Emerging market currencies like the Turkish lira or the Argentinian peso were hit hard by these US moves. By roughly late 2024, however, the Fed signaled that peak rates might be here or near, and even started cutting rate modestly. That changed the picture again. When the Fed hinted at rate cuts, we saw the US dollars pull back a bit in 2024, easing some pressures off other currencies. Meanwhile, other major central banks like the European Central Bank, the Bank of Japan also adjusted their policies on their own timetables. The back and forth created big swings. For instance, if the Fed held rates high while ECB cut the euro, you would see the weakening of the euro versus the dollar and vice versa. So in short, US policy has rippled out through Forex. Trade wars added a layer of uncertainty while Fed moves drives the overall flow of global capital. So traders have learned that a Trump tweet or a Fed governor's speech can mean quickly big moves in currency pairs, something that is, I would say, far more prominent now than it was a few years ago.
I mean, I think that's definitely an understatement with all of the news going on about Trump and Jeremy Powell.
Yeah, most stuff.
Yes, definitely. So with this in mind, knowing that it isn't just the US dollar that traders should be watching, but it is a pretty volatile market right now. It is a very scary environment for a lot of new, fresh traders looking to want to dabble in Forex because historically it's always kind of been the go-to easy, quote unquote, easy trading, right? Whenever people are telling you that you should trade, you're going into buy currency, trade, exchange currencies, go into the dollar, the pound, the euro. With all of this volatility going on, how should global traders adjust their strategies and what should they keep in mind about reacting, especially reacting to all of these moving parts?
I would say, I mean, they have to keep themselves really nimble in situations like this because you can't have just one fixed strategy towards dealing with trading the currency, but being nimble and do expect surprises and stay very, very flexible. I think that will be the best way to deal with it at the current moment.
Would you mind giving us some examples about how, like, this part with being nimble and being flexible might be applicable in Forex?
Say, for example, I would say, it's with the situation with Trump coming in, and he gives all kinds of, the tweets, and he changes direction from one to another, right? So it's good for traders to expect surprises, but at the same time stay flexible. Because what's happening right now is that the old certainties like cheap debt, stable globalization, this has given way to more nuanced trends. So I would think being a trader, especially a savvy trader, you should be like you approach the strategy like a detective, looking into all these details, right? And then or check all the corners, being prepared, and part scientists get the numbers, crunch the numbers, looking at them, and part historian as well. Knowing that the at the current moment we have what we call de-dollarization, and that is part and parcel of what I call the changing of a world order. So that's a part of being historian. And when you understand these movements, you understand why this US administration is doing to the US right now and how it's going to affect the dollar and so on and on and on. Why they are against China, because at the current moment, China as it's an upcoming economic superpower. And because of that, they will be able to threaten the maybe to be the future leader, of the new economic order, and that scares US because US is like 34 trillion in debt, right? And they don't want to lose this currency reserve status and number one status, and losing that would mean a big blow to the US. So that's the reason why I said, due to all these changes, you need to be nimble and expect surprises, but at the same time, being flexible. You can change, put on a new hat.
Being able to adapt is, I think,
Yeah.
a very key part, especially with all this in mind, especially mentioning China as well as what you previously mentioned about technology, especially. I think it's only fair that we touch on technology and AI because it's such a big role of, especially lately with this tension between China and the US as well, right? With DeepSeek, ChatGPT, the chips manufacturing. I think we've also been hearing a lot more about how AI has been trained into doing algorithmic trading these
Yeah.
days. How do you see these advancements affecting Forex trading?
Well, I think one of the most talked about trends in Forex lately is, of course, like what you said, artificial intelligence and probably algorithms as well. So, but I would say algorithmic trading isn't new, but it got a huge boost in the last few years. Banks and hedge funds have algorithm doing the grunt work, scanning news feeds, analyzing millions of data points, and executing trades in split seconds. So in fact, survey shows that more than half of big institutional money managers now trade a majority of their FX portfolios using algos compared to a few years ago. So for everyday traders, AI tools have also become accessible. Believe it or not, you can now plug something like, say, ChatGPT into market data via special plugins and ask it to summarize the latest economic reports or even generate basic trade ideas. You can get this from YouTube easily, how to make a simple algo trading and so on. So for example, if you're following the euro dollar pair, you might ask, what's driving it today, and get a quick rundown on ECB minutes, US jobs data, or trade headlines courtesy of AI. You can actually set that, in ChatGPT itself. So some trading platforms even use machine learning to spot patterns in price charts or new sentiments faster than a person could. You can see this a lot, especially if you're trading cryptocurrencies. So these AI-driven tools have real benefits. They can process news like 24/7, flag events, uh, central bank announcement or tweets in real time, and run simultaneously everything in minutes. But at the end of the day, you have to remember they are not magic. Okay, so AI model might be great at normal market days, but can flop during an unprecedented shock like the April 2nd announcement, the tariffs, where everybody expected it not to be that bad, and it turned out to be a really, really bad for the market. I know some algos had issues and people lost a lot during that time. So basically, I think experienced traders now, it's better for them to use AI as a helper, but not treat it as a boss. AI is there to crunch numbers and keep you informed, but it still takes human judgment to say, wait, this time it feels different. Maybe I won't plug in this AI. So I would say AI is changing Forex, definitely making it faster and more data driven. The landscape has thousands of quant funds and smart algos duking it alongside human traders. So I treat it, more like the kinds of like arm race. Everyone's trying to use the latest tech to get an edge. The good news for individual traders is that even retail apps now offer features like automated technical scans or new algos, new bots. The bad news is it means that the market moves even more sharply at times since the algos respond all at once. So you just have to be careful. And like I said, don't, treat it as a helper, but not the decision maker, the boss for everything, you know. So it's a double-edged sword. See how you just mix on, treat it well, use it well.
That's fair. Be kind. I mean, so then it is fair to say, in essence, I mean, your algorithm, any sort of AI is only as good as its coding and training.
Yes.
So then this is kind of a rhetorical question, but a follow-up, an important follow-up, because a lot of traders also probably are asking this question in their minds, is will automated trading ever replace manual trading?
This is a very good question. I think the short answer would be not completely. Yes, automation is taking over a lot of tasks. Many routine jobs in Forex, like executing known strategies, monitoring dozens of pairs constantly, sticking to discipline, are now done by computers. So I think the automated trading systems execute all these precise plans. You feed them without emotion or fatigue. I think that is a crucial one, especially as you get older. You get tired faster. You can't concentrate. So these AIs, these automated tradings, is there to help you. Definitely, they are super fast. They can exploit small price differences like arbitrage trading or react to news in milliseconds. That could help you a lot, in the calculations and so on. So definitely it will help, especially in those like high frequency trading firms. They use programs that can buy or sell millions of dollars in currencies in a blink of an eye, faster than a human can click. So that will help. But to me, I think humans still play key roles. First is like the most important thing is strategy design. Someone has to decide what rules the algorithm follows, like creative strategy, the understanding of macroeconomics context, and the ability to handle completely new scenarios is still very, very human. Okay, so, and not to forget, automated systems can malfunction just like any software. For instance, a glitch in a trading bot once caused some big losses for a fund because it kept placing trades incorrectly. So humans need to watch and monitor and say, hold on, something's wrong. So I'm not going to, I have to do something to it. So I would say that, humans, they possess what we have, intuition and experience. So they can sense when the market feels weird and step in or step out. Sometimes, something an algorithm can't mimic exactly. So if I would say, think of it like an aviation where autopilots can fly planes for hours and handle smooth conditions perfectly, but pilots still take over in turbulent weather or emergencies. In the same way, automated strategies are great at smooth sailing or well-defined situations. When a truly black swan event hits, human judgment to me, it's very, very crucial because being being able to adapt to that situation is something invaluable at that point of time. So I would say nowadays, what we see today is basically a hybrid market. Many pros and even individuals, traders use algos to handle part of their operations, but leave the big picture decisions to themselves. So in a nutshell, to answer the question, no, robot won't fully replace humans in FX anytime soon, but they will continue to play a huge support role.
Okay, that's great. I think that pilot and plane analogy, I think, definitely drove the point home, is that any sort of machine needs to have a human touch behind it. So that's a really great recap of everything. Great. Thank you, Justin, for those insights. Those were very informative details. Now I'd like to go into something that's probably been on everybody's mind since the April 2nd Liberation Day tariff talk, is this possibility of a global recession happening. Now, this trade war and this escalating back and forth with tariffs are definitely fueling a whole lot of fears around a lot of the trading markets. But specifically with Forex, how does the risk of a recession affect foreign currency?
Well, the buzz of global recession risk definitely has been humming in the background for a while. People talking whether we're gonna have a soft landing or hard landing, and even maybe we are looking at stagflation, which is the worst kind. So when people worry the world might tip into recession, the Forex market typically shifts into defense mode. That's what we're seeing nowadays. So what does that mean? It's usually safe haven currencies get bought and risk sensitive ones get sold off. So for example, during the recession scares in 2022 and early 2023, many analysts expect the US dollar and the Japanese yen to strengthen. The US dollar often benefits if a recession is seen as more harmful to other economies than to the US, because the US market and its government bond is considered a relatively safe place to park money. Likewise, the yen has a long history of rallying in global crisis. Uh, Even though Japan's own data is weak, investors view it as a defensive asset. We saw hints of this late 2022 as well, and right now, early 2025. So in March 2025, headlines suggested new US tariffs might be on the way, and we saw the Japanese yen jumping up like 0.8% in a day, and gold hit record highs as traders dump risk assets. So in that case, the thinking was, dang, if a trade war or slowdown is coming, maybe buy yen and wait it out. And meanwhile, currencies of countries that rely on exports or commodities tend to suffer. So commodities currencies are like the Australian dollar, the New Zealand dollar, the Canadian dollar. These especially the Australian and New Zealand, they are linked to commodities and tied very closely to the Chinese economy. So typically they slide if growth fears rise. So another angle, you can say, in a real or feared recession scenario, central banks often pivot. If the Fed starts cutting rates to stimulate growth, the dollar yield advantage shrinks, so its support may fade. At the same time, if you say the European economy is weaker, the European Central Bank or the ECB might also ease as well, which could also weaken the euro. All these rate moves add to all these currency swings. So it's basically who is cutting more and who's cutting at a faster rate. So Global downturn worries tend to make forex markets more volatile. Investors, they like to rush to safety, favoring liquidity and stability. So in uncertain times, I would say preserving capital often trumps chasing profits, and that mindset shows up as dollar, yen, the gold strength, and broad selling of emerging market currencies. Um, it's in the forefront. So that usually what happens.
Right. Okay. So I know that you mentioned this well that it has been a safe haven currency for a very long time. And this is quite an unprecedented sort of scenario with that. Does the dollar still hold a safe haven currency position at this point for investors?
Definitely, at this point of time, the US dollar still, I would say, still has that status as the number one currency reserve. Uh, but the actions of Donald Trump almost tipped that scale. But if you look at it from a market point of view, I would say that the de-dollarization has happened. But it's not something that you will see overnight and say you wake up tomorrow and somebody tells you that dollar is not important anymore. It will still be for the next couple of years. But the actions of the Trump administration and after Trump is crucial, and it will determine how long the dollar would stay relevant, I would say. So it's really entirely up to them. But at this current point of time, I would still say that it's still the number one currency reserve, but they need to be very careful.
All right, got it. So I want to ask these next questions, but I feel like you've kind of touched on exactly how the tariffs are affecting the currency pairs. But I think this next following question might be a little more relevant to our listeners as of with these commodity currencies and everything, how should traders adapt to pairs as these tariff policies are rolled out? Because this is quite a new situation in the recent years.
Sure, I can give you a simple way to think about it. Let's say country A slaps a tariff on imports from country B. It makes country B's goods more expensive in A's market. So country B sells less to country A. So there's less need for buyers in country A to hold country B's currency. That usually weakens country B's currency relative to country A. A real example, when the US put large tariffs on Chinese products, exporters in China got hurt, and the Chinese yuan dipped against the dollar because people needed fewer yuan to meet the US demand. Conversely, the US might see its currency strengthen in isolation, although it's more complex in the global puzzle. Because why do I say strengthen in isolation? Because most times terrorists don't work in isolation. They often bring retaliation. So only Trump, when he introduced that and said, if you don't retaliate, you won't regret it. We will discuss with you, we will negotiate with you but like I said, most time terrorists don't work in isolation. They often bring retaliation. So China retaliated, but the rest did not. But some will. We don't know. I think we have about 70 days till we find out. So, for instance, if the US tax import cars 25%, the car exporting countries might tax something else. That can happen. So that's why today we have news of Trump saying that, about this cars, that we will look into it and probably bring it down lower. Because these are all things that, it's going to hit back US as well. It's just not just one way. So those tit for tat moves can suddenly shift forex flows. So we can say tariffs add volatility, so traders today, like I told you early on, we need to be very, very nimble. And so I would say if you want to trade in the Forex world, the most important thing right now is to stay informed, watch for trade policies news closely. A single tweet or announcement about tariffs can move major pairs. And don't just trade one pair, diversify your currencies. So if tariffs shake up US-China trade, a pair like the dollar yen might behave differently than the dollar versus the Chinese yuan. So spreading exposure can smooth out the shocks. So I think also you need to be vigilant in the short term around tariff announcements. Spreads and volatilities often can widen. So it can be a smart move to actually reduce position sizes or even stay aside, mostly on the sidelines until the dust settles. So these are things that you can do.
Okay, great. That sounds great. And I'm going to just recap very quickly for everyone. The key to Forex trading currently in this market, according to you, is to remain extremely flexible and nimble with the way that you're trading your currencies, to hold a very diverse portfolio, and to kind of basically not put all your eggs in one basket, not to jump at the first sign of uncertainty.
No, I think it's just staying informed and not to be loud. Like I give you a very, very good example of that. The in March, right? What happened from mid-March right up to the end of March, right? We saw the S&P 500, the S&P 500 recovering because traders, they were thinking that everything is back okay, and they assumed that Trump, on the April 2nd announcement, it would be something really just a normal tariff announcement, that it won't hit everyone that bad, but they were real dead wrong. That's the reason why I said you have to stay informed and don't expect things to be like what the masses think. You need to be really informed and watch all this news closely. So, like for example, if you have and they inform 90 days, and before they decide again on the tariffs, right? So there's a pause there. So we expect the the negotiations to happen, and all those major economies like India, China, we expect negotiations to be done before the end of these 90 days. So if you don't get any announcement from the US pertaining to all these tariff discussions, I think you really need to be careful and expect huge movements to come again in the dollar and the US stock market as well. Don't and if it's like the US market is recovering, expect it to have a big dump at the end of these 90 days. So, but don't wait until 90 days. Practically at the 80th day, you should start looking into profits, taking some profits off the table. If you have bought some of the stocks during this recovery, I think it would be prudent to do that. So that's why I said stay informed and being vigilant, because volatility is the name of the game at the current moment.
Right. Okay. Got it. So it is flexibility, nimbleness, and also be staying informed, being up to date with the news, being able to take steps to protect your assets and yourself. Okay.
If you want to add one more thing, I say stay curious and skeptical. Don't rely
Absolutely.
on this is how it always work and it always should be like that. It doesn't work. Yesterday patterns might be different. So always ask questions. Why is it moving this way? Why is it moving up? Why is it coming down? Challenge your assumptions constantly. I think that is one of the smartest way to deal with the current market.
Absolutely. I think that is absolutely right. And that's the mindset and the way to live your life, basically. It's just always being curious and being willing to question things.
Yep.
And making the right choices. Absolutely. Well, thank you, Justin. I think we're just about ready to wrap up. But before we do, is there a simplified mindset that traders can hold on to in this stage, which was what you were talking about?
The mindset. I think the number one mindset, is to, in the trading world and investment world, is to embrace risk management. Focus more on protecting capital than on big wins. It's not about feeding the ego, it's about making money over here. So I think capital protection is important. In choppy markets, preserve what you have. Use small positions, tight stops, and know exactly why you enter a trade. If the trade goes against you, the thought shouldn't be panic, but rather, is my premise still valid? If it isn't, then get out. So I think that's crucial. The next part I think is to whenever you think in a big picture, with policy changing, all these changes coming fast, link your trades to the macro story. So if the Fed or the ECB, the European Central Bank policy diverge, it makes sense that the euro dollar might trend. So let's say the Powell says that, hey, I think I'm going to maintain rates and I don't care what Trump is going to say. I don't have enough data. But you have the ECB coming out saying that, okay, we are going to cut rates. US is pulling out from this. I hope not, but let's say, give you example, US is pulling out from the Ukraine war negotiations. So the war will definitely weaken Europe further, and with the US maintaining its rates, so you have a huge rate differential over there, and you will see actually the US dollar trumping the euro dollar at that point of time. So these are things you need to understand. So also look into things like, if the recession is looming, ask which currency is seen as a safe haven. So basically, always connect technical moves to real world developments. Another thing I could think of is to stay disciplined and patient. Emotional trading in wild times, definitely, I would say, it's a surefire way to lose money. Stick to your rules. Whether that's a trading plan uh, or a gut criterion, you need to understand that well. So don't chase every move. Sometimes, not trading is the best trade ever because you're not losing money. So sitting out of these storms and waiting for clearer skies, those I think is our wise advices that was given to me in the past by good traders. And finally, I think, don't stop learning. Markets always evolve, and so should you. So spend time each week reviewing your trades, study new analysis tools, or understand the world economic order, read about history in the past, why nations succeed and fail, whether learning AI is going to work for you or not, how is it going to improve your AI, like we spoke about just now, refreshing knowledge on monetary policy. So basically, keep your skills sharp. So I would say, think like a navigator, not a fortune teller. The market is your ocean, and your charts, the news feeds, and experiences, all these are your compass. Conditions will always change, from high waves of volatility to calm periods. So to cap it all, I think a strong Forex trader today is flexible, humble, nimble, and always ready to adjust the sails based on the winds. Hope that is not too philosophical to you.
No, I think that was the perfect way to cap off everything. That was very well said, Justin. Thank you. And I think that will be the perfect place to cap off today's podcast. So, a very huge thank you to you, Justin, for sharing all of your knowledge today with us. It was very, very insightful to see how the Forex markets have been moving. And these are very, very key lessons I think that anyone can take and apply even beyond the trading world in order to really achieve the success I think we want to see. And thank you to all of our listeners for tuning in. If you're looking to navigate these global market shifts, VT Markets provides tools, resources, and insights you need to make informed decisions. And you can check it all out on our website and app. If you've enjoyed today's episode, don't forget to subscribe, leave a review, and share it with your fellow traders. And of course, let us know what topics you'd like to hear next. Until then, stay smart, stay informed, and keep your trade steady in these uncertain times. This has been Cass and Justin at the Traders Brew, signing off. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. Trading leverage products such as Forex and CMDs carries a high level of risk and may not be suitable for all investors. There is a possibility of losing all your initial capital. Before trading, you should fully understand the true extent of your exposure to the risk of loss and your level of experience. Please note that past performance does not constitute a reliable indicator for future results. Likewise, future forecasts do not constitute a reliable indicator of future performance. If you do not fully understand the risks involved before deciding to trade, you should fully consider your investment objectives, level of experience, and risk tolerance. You should become aware of all the related risks and seek independent advice from a suitably licensed financial advisor.